Thanks for the invite, and hopefully I can add some value today. I think I've done this presentation a couple times over the last few months, and I think it's the time to be talking about some of these things in our business. I think this is obviously I'm a multifamily guy, but I think this kind of goes across the spectrum of commercial, really, and really maybe even a little bit of single family too. I think there's just risks right now in investing that have and the dynamic and the industry has kind of changed a little bit over the last couple of years. And I don't have to really get into it too much, but because we talk about it on the news every single day. But interest rates and inflation is just a hot button topic. So I wanted to kind of talk about today the 10 biggest risks that we're seeing in commercial real estate investing and how to mitigate them, right? Because there's always ways to mitigate risk. This is not a risk-free endeavor. I mean, obviously, in any type of investing, unless you're just stuffing money under a mattress, is always going to have some level of risk. But it's all about how do you mitigate it, and what types of folks are you investing alongside with, and what is their acumen and wherewithal to be able to kind of weather some of these challenges that we have. So, all right, so let's see if we can get into this right now. So bear with me here. Boom. All right, so I am that bald guy. I'm wearing a hat today because I saw Joseph wearing a hat, and I was like, all right, let's keep it comfortable. But Ben Suttles, again, managing partner of Disrupt Equity. I'm a father first. That's what I always kind of tell people, because we work really, really hard, and you got to have a why. And my why is my daughter, right? From there, I'm an entrepreneur. Then I'm a real estate investor. That's kind of the hierarchy of what I am in my life, right? But I started off in corporate sales, did that for about 15 years. Was lucky enough to kind of segue that into single family investing. And then from there, I kind of got burned out a little bit, running around town. I still had a W-2 job at the time, flipping houses and dealing with tenants. It was a little bit of a drain. So I started kind of looking for other opportunities, and I stumbled my way into multifamily. And so that was back in 2014 that I got into multifamily. So I've been in it for about 10 years. And, I was lucky enough through a networking event that I still host. I actually hosted one last night, a meetup that we host here in Houston, to meet my current business partner, Ferris Musa. And we started Disrupt Equity in 2017. So I was doing some deals kind of on my own with another partnership ahead of that. And then, I met him. He's one of the smartest guys I've ever met. We just kind of really, really jived. His skill set's a lot different than mine. I'm more kind of a sales and marketing guy. He's kind of a real data, processes, ex-Microsoft software developer. And, it goes well. So to date, we've bought and sold about 5,500 units, currently have about 800 million in assets under management. And, we like Texas, Georgia, and Florida. There's a couple other markets that we like too, but, since we're vertically integrated, we have our own management company. We're really, really kind of strategic about where we buy. And we love those markets for various reasons. Obviously, population growth being probably the number one. The lack of just kind of, housing in these markets, tax-friendly, business-friendly, landlord-friendly, all of those things are important when you're investing, right? And, and for those, if I say anything bad about California, just know that I lived there for 10 years. But, ultimately, I love California as a state, not necessarily worth a place where I'd like to invest for various reasons, right? So those are just some of the exits. One of the things I'm very, very proud of is we got ranked number one fastest growing company in Houston in 2022. We were number two. We didn't get number one. We were number two last year, but we're trying to kind of regain that title this year too. So we'll see how it goes. But so that's just a little bit about me. But let's hop right into this. Risks in commercial real estate investing. And I'd say the number one risk, and this doesn't matter if you're doing single family, doesn't matter if you're doing commercial, doesn't matter if you're doing multifamily, you don't want to overpay for something. Right? Buy it at a good basis and don't get caught up in the hype. I think in a lot of ways, multifamily specifically, and it was really kind of on a rip and roar tear for the last 10 years. But even in 21 and the first half of 22, it was on fire after COVID. And I think a lot of people jumped in because they saw some money that they could make, and that just bid the price up. And then you get into this situation where now some of these people are stuck. And so, you always want to kind of look as, does this feel good on a basis play? And, can I make money even if there's a little bit of a slowdown in the market, right? So that's the number one risk. I always tell people, don't overpay for something, right? Number two, buying in the wrong markets, right? Trends matter, population growth, job growth, rent growth. What's the median income in that submarket? Is it diversified economy? And I'll kind of get into the diversified economy piece because I think that's important. A lot of people get caught up on, oh, I'm buying in, I don't even want to say, just some secondary, tertiary market, right? And it's a 10 cap. Well, there's a reason that that's a 10 cap when everybody else is buying it at a 6 or 7 cap, right? And it's because it's a sleepy market. There's probably one factory or one industry that drives the whole entire economy. And guess what? What if that slows down? What if that factory goes out of business? Now that 10 cap is going to be a 20 cap and you're just trying to offload the dang thing. So we kind of try to stick to those primary markets where there's diversified economies and there's multiple drivers, not just one driver. And I think that people kind of get caught up in that and they kind of get, oh, this feels like a great deal. Well, there's a reason why it's a 10 cap, right? So I think that that's important to kind of make that distinction. So number 3, this is a big thing that's happening right now. A lot of our colleagues in the business, they just didn't have enough cash reserves. It used to be 6 months of expenses and debt service parked in the bank. Right now, I'd say you need to double that. And I think that there were some people that didn't even have 1 month of debt service and expenses. And so when things started going up, interest rates, insurance, all of these things, these people ran out of money. And that is what's really, I would say that's one of the biggest drivers right now is people are undercapitalized. They don't have any more cash. And they're trying to feed the deal out of their own pocket. Well, we're all not billionaires. And so at the end of the day, that money's going to run out. And then what do you do then? Right? Because I'm going to tell you right now, but I got my crystal ball out. I don't think the Fed's lowering rates. And if they do, they'll probably do one token rate reduction in the fall, just right before the election. And ultimately, I think we're into this higher interest rate environment for at least another 12 to 18 months. So if people are already running out of money now, you can imagine what kind of a bloodbath it might be in 12 to 18 months. So just that's an important thing. Have enough cash reserves, right? Risk number 4, wrong capital stack, right? And so people, this is a term, Valerie said I have to, I need to explain some of these terms that we kind of get into. So this is a capital stack is essentially how are you structuring the deal? Right? What type of loan are you putting on the property? What type of equity are you bringing to the deal? Is it pref equity? Is there mezz loan? Is it common equity? All of these things matter. And they really, really matter when the things go south. And so having the wrong capital stack it can be detrimental to a property. And I think, let me give you guys an example, right? Putting long-term debt on a short-term hold can kill profits. Right? We all kind of got caught up in this, like, let's put everything through Fannie and Freddie. Let's put a 10-year fixed rate loan on it. Well, those permanent loans are great in some respects, but they come with very onerous prepayment penalties. So if you knew that you were going to infuse a bunch of money into a property and you were going to flip out of it in 2 years, why would you put a 10-year note on it? Right? And so people kind of, they don't like to use bridge. Bridge is this taboo word these days when everybody used it 2 years ago. But bridge is a tool, right? And you have to use the right tool for the right function. And so if you're going to flip out of a deal, you're going to flip out of a deal. Why would you put long-term debt on it, right? You're just going to kill your profits because that prepayment penalty can sometimes be 20, 30% of the loan amount. It's a lot that you're giving back to the bank when you try to sell this thing. And I'd say the other thing, probably behind not having enough cash reserves, some people in our market were over leveraged, right? We were already buying at the top of the market. Then you're going to put 80% debt on it. And then some people on top of that were putting pref equity that got them all the way up to 85%. Guess what? Those people are smoked because at the end of the day, they're way underwater now. There's no way they're going to be able to refinance. And even to try to sell out of the deal, you're most of the time you're selling it for less than the loan balance. And so never over leverage. Typically in the commercial real estate space, we try to stay between 50 and 65% leverage. And I think that that's what's going to help us moving forward in comparison to some folks that were doing that 80, 85% levered deals. So having the wrong capital stack can be a very, very risk in this market. All right, so let's kind of dive a little bit into loans, right? I kind of talked about bridge versus permanent. What the heck, what is this guy talking about? So a permanent loan, typically going to be backed by Fannie Mae or Freddie Mac, right? It's going to have a fixed interest rate. Right now, you're probably talking anywhere from, I've seen it on the low end, 5 3/4. upwards of 7 is what they're kind of offering right now. Long-term holds, again, you put the right loan on the right business plan, right? So if you're going to hold the property for, I'd probably say 5 to 15 years, it has 7 in there, but that's when you want to use these permanent loan products. But like I said, big prepayment penalties. It's called yield maintenance. It's called defeasance. Look those things up on Google. They are tremendously bad, especially call it the first 3 years of the loan, because they're going to catch up on that interest when you sell the deal. They're never going to just be like, oh, don't worry about that, because at the end of the day, they bundle all these loans up and they sell them as a bond, right? So the bondholder is expecting that 10 years worth of interest. And so what they do is like, okay, you want to sell it in 3 years? Fine. We're going to calculate what the rest of that 7 years is, and then you're going to still pay it at the closing. So sometimes, again, can be upwards of 20, 30% of the loan amount. Good for stabilized deals, right? So think 90% occupancy and above on the multifamily side. And I think, if you've got a good deal, you're planning on holding on to it a long time, and you're just going to ride it out, those are great products, right? So bridge, the other side of the spectrum. These are variable interest rates, right? And then I put in here, better buy a rate cap. What is a rate cap? A rate cap is essentially a hedge that we put in place that essentially, makes sure if the interest rate goes up and it hits this hedge, everything above that, the cap will pay. It's like an insurance policy, essentially. And so what ended up happening in a lot of respects is all of those are in the money right now. So the rate caps are paying, sometimes 6 figures to offset that mortgage payment. So because the rate cap provider is paying you money, and then you're paying that to offset your mortgage, because the lender is just going to, whatever rate it is, that's what they're charging you, right? So it's important to buy a good rate cap. Some people are going to buy one that's really, really high up here. Well, all of that run up is now on them, right? But if you buy one that's a little bit tighter, like we like to say, you're going to have that hedge is going to pay you a lot more, right? Bridge is definitely better for short-term holds. 1 to 3 years is what you got to kind of think, right? Little to no prepayment penalties. Again, if you're planning on flipping the deal, this is a great product. Right now, just to give you guys some perspective, this money's probably, I've seen it on the low end, 9. And then you can have hard money type rates. I've seen people get sharked at 20%, but I would say you're probably anywhere from 9 to 13 is probably the range that you're going to pay for this money right now. So it's pretty expensive. That's gonna suck some oxygen out of your deal, just because you're paying so much in interest. Right. But again, if you're not looking for cash flow, you got a great basis, you're going to put some money into it, you're going to flip out of it when the economy gets a little bit better, maybe this is a good option for you. Because again, these are good for properties that are not stabilized or they need a lot of rehab. Right. So that's just a little bit of a background on loans. Right. So risk number 5, rising interest rates. You can't get through a news cycle without talking about interest rates and inflation. Right. So, again, I talk about buying a good interest rate cap or putting fixed rate debt on it where you don't have to worry about rates going up, right? And if you can go in lower leverage, Fannie and Freddie are great options for you, right? Again, this is not like the great financial crisis. There's still a lot of liquidity in the market. There's still lenders lending. Fannie and Freddie haven't gone insolvent like they almost did in 2008 and 9. And so they're still lending. And that is their job. Their job is to provide liquidity in the market. And secondary to that, their job is to provide, loans for affordable housing too, right? That's just part of their charter. So that's how you're going to have to mitigate those interest rate risks through doing these various things. And Fannie and Freddie is a great option. Risk number 6. This is a big thing that's kind of been kicking everybody in the teeth the last couple of years is insurance has just gone up. I bet everybody has probably seen that renewal on their car insurance or their house insurance. Even that's gone up. Insurance across the board has gone up. And the reason being is the insurance companies were losing money in certain markets for years to the tune of billions. We own an insurance agency, and so we have a lot of good contacts with insurance carriers. There was a guy that was telling me that they had lost, I think the insurance industry had lost 20 billion in Florida over the last decade. And that was before those 2 hurricanes that they just had to pay another $10 billion in claims on. So what they all kind of colluded together to come do is, okay, everybody's getting a rate increase. And what ended up happening is most of that goes to the commercial side, just like, property taxes and stuff like that. They typically stick that on the commercial folks more so than, say, a single family, resident, right? So working with an experienced commercial real estate insurance agent is important. And I'm not, bashing on State Farms of the world or any of those other folks. Sometimes those guys can be really, really savvy, but this is a very niche thing. And putting multifamily insurance is you have to know the right carriers, you have to know the right brokers that can do it. They know how to structure those types of insurance products, and so you need to work with ones that are good. We use a company, Strategic Insurance Group, here in town, and those guys really know what they're doing. Right? Don't cheap out on coverage, or try to let me just if you're just looking for price, that can be detrimental. It's real easy to just say, hey, I don't want to pay that big premium. So why don't you just, increase my deductible or whatever? Well, at that point, you're almost self-insuring, right? If your deductible is 10% and you have let's just call it $1 million loss, that's $100,000 coming out of your pocket. Do you have $100,000 to stroke that check? Does the property have $100,000? And so, I think that's important. And this is not maybe for people outside of Texas, but FEMA, there's obviously floodplains here in Texas. So always check that your property, if it's in a flood zone or not. If it is, get flood insurance. And I'll do a quick, just kind of side note to this. My first deal was a property called Huntington Park. It was in Beaumont, Texas, which is 90 miles east of Houston. And it flooded during Hurricane Harvey. So I had an $8,000 FEMA flood insurance policy, right? That we almost decided not to renew because, it's never going to flood. It hadn't flooded in 20 years and we don't really need it. The lender doesn't expect us to get it. Well, we ended up renewing it in July. Hurricane Harvey hits in August and we had 33 units that went down. It was a $2.5 million claim. So some can sit there and chuckle and say, well, that's the reason why FEMA is going out of business. But that's the government. They don't run anything very efficiently. But point that I'm trying to make is don't cheap out and say, I don't need that. You probably should get it. Flood insurance is worth it, especially if you're in those floodplains. So getting the right insurance is very, very important these days, right? Risk number 8, property taxes are going up. I kind of talked about this a little while ago, right? Hire the right experts that know how to protest these tax increases. It's incredible. It's like you're just getting hammered on all sides. Interest rates are going up, insurance is going up, and taxes keep going up. And the appraisal districts are ruthless. Don't be that guy that's trying to put all the information together. I'm going to go to the board at the appraisal district and try to talk them out of it. Doesn't work. Yeah, and maybe it works in your single family home, and I'm going to tell you on a $50 million asset, that's not how it's going to work. You need to go to the guys that have those relationships with the appraisal district. They're going to be the ones that are going to be able to get those reductions. And one thing that I always tell people is you should only be paying property taxes on the bricks, sticks, and land. A lot of things that you kind of take you take for granted, like websites and furniture and fixture, all these little things, right? That you shouldn't necessarily be paying for all of that as part of your property tax valuation. And so again, these property tax consultants can, strip out some of that and really kind of go back and make sure that you're only paying property taxes on the things that you need to. That's part of the property tax code, right? And, I'm from Texas. We protest this thing. I protest my house even if I feel like the valuation is good. It's just what we do. And I think even in other states, you should be protesting. And there's great companies out there. I'm not going to, name any because, whenever I've done that, somebody's had a bad experience in it, but just look them up, get a good feel for them and ultimately protest it. Because again, the appraisal districts don't care. Sometimes they're just throwing out a number to see what sticks and they're hoping that you just don't protest and you just say yes. So they're almost wanting you to say something back just to kind of get some good data for them. So that's property taxes, right? Number 9, investing with inexperienced operators. I think this is going to be another thing that we're going to kind of look back in 12 to 24 months and we're going to realize that some folks shouldn't have been buying properties. They just didn't have the infrastructure behind them. They didn't have the knowledge. They didn't have the time. They didn't have the wherewithal to buy. And this is not like, you should only invest with me. the point is that you should just be very, I guess, skeptical of people that maybe have not done a lot of deals and have not gone through some challenges and don't have that infrastructure on the back end to help them kind of get through some of the rough patches that we're in our business, right? So, and I'm an LP on 29 deals. So, and that's not just our stuff. So I invest with other people too. So what am I looking for, right? Ultimately, you're backing the jockey, not the horse. I'm going to start from the bottom because this is probably the number one thing that I look for. I get on the phone, I talk to those people. Right. I understand what their experiences are, right? Do they have business experience? Have they been through different market cycles? What's their infrastructure? What's the team look like? How much wherewithal do they have? Do they have skin in the game? I think that all of these things are important questions that you should ask the operator before investing in anybody. Because people kind of get caught up on, oh, that deal looks sexy, or I love that market. They don't even ask who the guy is that's running the deal. And so I'm saying you got to flip it on its head and you got to ask about the operator first. Then you're talking about the submarket. Then you're talking about the deal. And the reason I'm saying submarket second is I can infuse a ton of money into a property and it can look like the Taj Mahal, right? But at the end of the day, if the submarket that it's sitting in is garbage, that I can't change that, right? That's going to be something fundamentally that's just going to be outside of my control. So the submarket that it sits in will all ships rise with the tide. That's the same with commercial real estate, right? And you guys know this. A lot of you guys are brokers and investors too, right? So looking for vertically integrated firms, strong track records, lead with integrity, and are trustworthy fiduciaries, right? We've raised almost $250 million, and that's what keeps me up at night. Is how am I going to not only provide a return on capital, but return of capital to my investors? And I think people need to understand that it's not, some people are just in it for the money. That's not why I do this, right? I do this so I can bring my friends and my family along, and my investors along, and we can all make money together. And that's the most important thing, right? So risk number 10, the macro economy. This is where we're talking about inflation and unemployment and interest rates and God forbid, World War III. I don't know. I feel like they're dragging us into something in Europe here. So you gotta watch that. That's a big risk. That's the black swan events that we have to be careful about because nobody can control that. And in that case, things could go way awry. So, cash reserves are king. I know there's the big thing is cash is king, right? Cash reserves are king. That's the most important thing. Making sure that you have enough money in the bank to weather that storm is important. Don't fight the Fed. People or tried, I know I went out on a limb and kind of made a prediction, but at the end of the day, nobody really knows. I don't know, so take my feedback with a grain of salt, right? But don't fight the Fed. They control a lot of the purse strings of how the economy works. And so don't go against them, right? CRE is hyper local. You guys know this, right? So whenever you see this doom and gloom, news article from CNN about commercial real estate and all these maturities, just knowing that some markets are going to go better than others. And it's just that's just real estate in general. It's hyper local, right? People need housing, the hierarchy of needs, right? It's water, it's food, it's housing. And that's not going away. That's why I love real estate. It's something tangible. It's not a stock. It's not crypto, which I do own, but it's nice to go kick the tires on something that's real. The land is there. It's never going to go to zero is my point, right? And so, and where you invest is important because, I'm just going to use Texas as an example. More and more people are moving here. There's not enough housing. We're looking at statistics. We need 4 million more housing units or whatever the heck they're calling them, homes, over the next 10 years. There's no way in hell that we're doing 4 million more. And so that is going to be good for us as investors because you're going to have a lot of good supply and demand, metrics that you can kind of play with, right? Valuations are going to go up, rents are going to go up, right? I always tell people, turn off the news. People get so caught up in what CNN or Fox or whatever news you like to watch is saying, and they get really just kind of manipulated almost in a respect to, but just realizing that doom and gloom sells. There's still some great things that are happening in the economy. I don't think that it's a complete bloodbath, but you have to understand some of these challenges, these headwinds that we have. So the bottom line is now the time to be buying real estate, right? I'm going to say yes. Reason one, why? Don't wait to buy real estate. Buy real estate and wait. Again, be a long-term holder. The times where we're flipping deals 2 to 3 years out, I think that time's over. I think you're looking at minimum 5 years on a lot of your holds, and I think that that's not a bad thing. Because that's really traditionally how real estate's supposed to work. We just kind of got caught up in, cap rates were compressing and people were just flipping out of deals because they were getting crazy offers on the stuff, right? But the fundamentals are still strong in multifamily, like I talked about, right? You still have a lot of good supply and demand structure, or things that you can kind of play, into. And I think there's still a lot of rent growth that's going to happen over the next kind of couple of years, right? Reason number two, demand is outstripping new supply in a lot of Sunbelt markets. I already talked about this, right? We don't have enough affordable housing. We don't have enough housing in general. It doesn't really matter if it's affordable or not. And then you got strong job and business-friendly economies will drive the growth for years to come. That stuff's not going away. Some of the stuff that you're hearing, those are decades-long trends that are going to continue. And that's why we invest in these kind of high growth markets, right? Reason number three, transactions are down. There's lots of buyers on the sideline, leading to more favorable pricing and terms with sellers needing to exit their deals. So you're going to have a lot of people that are sitting there pencils down, and you're going to have some sellers that are going to be like, I've got to sell this. Who do you have? But transactions are down for us 90% from the high in Q1 2022. And so that's a tremendous drop in transactions. So there's not a lot going on, but that's leading to more favorable pricing. We're buying a deal, and I'm not trying to pitch it. We're buying a deal here in Houston at 2017 pricing. The guy's taking a $30,000 a door haircut on the deal. And so you're going to start seeing more and more of those. And so I think if you can get through and mitigate some of these risks, get off the sideline, I think this is going to be a tremendous buying opportunity over the next 12 to 24 months. In fact, I think it's going to be the best buying opportunity that we're going to have seen in 10 or 15 years. Reason number four, Fannie and Freddie still love multifamily. Again, there's a ton of liquidity in the market, and they're there to backstop the whole entire industry. They have 85 billion a piece every year that they have to spend, right? They're looking for deals. And so that's obviously a great thing to have them kind of backstop the whole entire industry, because it's not like 8, 9, and 10 where nobody was lending anything. And so I think that, if you want to get into it and your deal supports a 6% rate or maybe even a 10% rate if you're doing bridge, why not buy it? Right? So there's still a lot of liquidity in the market. Reason number five, I love this quote: be greedy when others are fearful, right? I don't know if that was Trump or not Trump, Warren Buffett or Carnegie, but bottom line, I love that, right? I think that's important when people are all kind of like, oh, I'm cautious. I'm laying in that, because I think there's a ton of opportunity over the next 2 years. Like I said, there's billions of dollars of loan maturities coming up. And I think that a lot of these people got to sell at a discount. They just bought at the top of the market. They can't refinance, and they're just going to sell it at a discount. And so again, you're going to step into a part of the market cycle that's going to be incredible. That's where fortunes are made, right? So if you want to stay in touch, check it out, team@disruptequity.com. We have a lot of YouTube stuff. We're all over social media, but we do host a lot of events. Like Valerie had mentioned, we do MFIN. We have meetups. So if you're here in the Houston area, we do a lot of events each month. But that's what I got. Love to stay around and answer any questions and network with everybody.
That was amazing. Thanks so much, Ben. It really created a lot of conversation and inquiries throughout your presentation, and you did fantastic.
Thank you.
I'd like to just kind of start out questions. I don't know if anyone else will have this one pop in, but first, I just wanted to point out, if I love like the golden nuggets. Sometimes it's a lot of information, but really to kind of pull that out. And I love how you talked about the tools. So that is a fantastic way to look at investing and brokering alike. You need to look at your assets and your lending and all pieces as tools. And so you need to use the right tools for the right plan. And so if no one caught that, definitely take note of that, because there's so much fear Ben talked about in the marketplace, and nothing out there is really bad. It's just all the tools that were provided were used incorrectly,
Yeah.
and they just didn't have the right knowledge. So to just realize that piece of it is so fantastic.
Thank you.
And I also wanted to add, he talked about CRE is hyper local, and don't watch the news. So that is where, if you ever feel like you don't have enough value to provide as a broker and investor, realize that just because you live where you live, you are valuable. You understand the marketplace, you understand what's going on, you understand the economy, you understand the population. Use that to your advantage 1,000%. Like that is what you're bringing to the table, because that is, you can't change the location of a property. So understanding where you're buying is huge. So just, utilize that and enhance that to provide that value for others. But with that, I'm curious, Ben, on your thoughts, because the market's changing, there's different pieces out there. What are your thoughts on owner financing or assumable loans?
So there's not a lot of owner financing going on, at least at the properties that we're looking at. I think that's kind of probably a little bit on the smaller side. We actually were doing a new develop. I'll take that back. We just bought an owner financing deal, but that was on the development side, right? We couldn't get a land loan if our life depended on it. We went to 103 lenders last year, and not one of them would do the loan on the development or on the land acquisition of the development side. So we went back to the seller like, hey, we're gonna have to walk away. And he said, well, what about owner financing it? And he ended up giving us an incredible rate. It was 8 3/4, and it was an 80% loan, on the land, and you weren't getting anything close to that from regular lenders. So I think if you have a good relationship with that seller, and they're not in need of the full amount, they'll just take a down payment, and they'll just, and there's people they'll do it for various reasons, right? Sometimes it's taxes, sometimes it's something else. They're just looking for cash flow. I love owner financing if you can get it done, especially right now, especially on deals that might be a little bit more challenging to get traditional lending on. Always go for that if you can. Assumable loans, we did 4 assumable loan deals last year. That was the only thing that we did last year. And the reason is there was a 3-pack of deals, and there was another one. The 3-pack had a 3.8% fixed rate for the next 7 years with IO the whole entire time. I mean, you couldn't beat that. Nobody's getting that anytime soon. In fact, they probably will never get that rate again. And so that's an incredible incredible rate to kind of step into. And then the other one was 4.21. And so again, you're not going to get that. So you're getting, and I'm buying those at 6-7 caps. So you have a lot of positive leverage. And so I would say if you can get an assumable loan and it works, just realizing sometimes it's going to be a lot more equity that you're going to have to bring to the table, just depending on where the purchase price is. And also understanding that the assumption process can be extremely painful. It just, it can just elongate the process. In fact, that 3-pack of deals took us 9 months to close. It was a CMBS loan assumption. It was painful, but we got it done. And I'm glad, because I love that rate. So I love both of those strategies if you can do them.
Thank you. Just for everyone on the call, he said his interest rate in IO is interest only for 7 years, which is like unheard of. That means you're only paying the interest on your mortgage and you're not paying your principal. So that is a fantastic piece, having that fixed debt in there. Thank you. Anyone else have any questions popping up right now?
Ben, quick question. Other than your Texas markets, are you looking at other states to invest? What is the growth plan for this equity?
Yeah, I mean, I think I'd always say that probably 75% of our deals are going to be in Texas, just because we're based here. Our management company is based here. It just logistically, it's a lot more. It's just easier. But we love Georgia. We love Florida. We love Tennessee. We love the Carolinas. But I think probably over the next couple of years, just because, again, we're trying to be strategic about where we buy, so our management company can be effective. So that's going to be Georgia, mainly the Atlanta MSA. And there's Atlanta has had some challenges with evictions and some other stuff, but Atlanta still is a great economy, great city, great place to invest. We love Florida. The problem with Florida is, first and foremost, insurance has just gone through the freaking roof. But the other problem is you have a lot of East Coast money, and you have a lot of South American money that just loves Florida. And so, we just get beat out all the time. People paying all cash on $40 million deals. I mean, I just can't compete with that. So it's always going to be competitive. Insurance is always going to be a struggle. So I would say probably over the next 2 years, our main focus is probably going to be Texas and Atlanta. And then, if we find another opportunity that makes sense, we would go into those other markets like Tennessee, Florida, or the Carolinas.
Go ahead, Matt, ask your question.
Yes, I just had a quick question. You had an example of 3 loans that you assumed, and it took 9. How do you convince the seller that it's going to take 9 months to close on a deal?
Well, most of these guys, they already know that. The assumption process is, it's been highly documented, just very painful and long. And so, but we bake it in there into our PSA saying, hey, we'll close 30 days from when we get the loan approval. So however long that takes, that's just dependent on your lender. But that was on the long side. Most of the time it should probably only take 4 to 6 months. But there's just some challenges getting some information from the lender. But yeah, if you bake that up into the PSA up front, the seller typically is going to be fairly sophisticated. They're going to realize that it's going to take a while. And then, you just try to, you show some good faith and try to get it going really, really quickly. But yeah, I mean, it's going to be, it would be a challenge if it was somebody that didn't know what they were doing and they didn't realize that I could see that going sideways. If you hadn't had those conversations up front.
Could you give them a better price when in that scenario? Just because they have to wait so long?
What, to just to incentivize them to give me the time to do it?
Yes.
I don't think it's worth it, right? I mean, again, They should know that their loan is that's just typical of loan assumptions, how long it takes. I would never pay a premium just to give me more time, right? Nah.
Okay, thanks.
No worries.
Go on, Stephen.
Good morning, Ben. Just as we do see more headwinds in the multifamily space, and we're starting to see some more challenges in that and transaction volumes being down, I'm seeing some operators starting to move to different asset classes. What are your thoughts on moving to different asset classes versus just zeroing in and getting more strategic on your investments in the asset class that you have expertise?
Yeah, I mean, I'm a big proponent of go deep, then you can go horizontal, right? I think it's real easy just to pivot and let's go find the next shiny object. And I have seen that too. It's like car washes and all this other BS stuff. And I'm just like, hey, we're multifamily guys, and so the only thing that we've kind of pivoted a little bit is just on the development side, but it's still multi. So I think this is the time to double down on operations. I think this is the time to communicate, let people know what's going on, be candid, be transparent. And, and so shame on an investor, especially if they're having challenges and then, just kind of neglecting their deals and going off and trying to chase something else. I've seen that too. And I just roll my eyes. But I mean, and it's, if things are humming and the economy's good and you've got a great team behind you that can go, that can kind of run the deal on their own, maybe do that. But again, if you're getting into this business and you're trying to build a name for yourself, go deep on it for 5 to 10 years. That's how I look at it. And then you can go horizontal and go start buying triple net or whatever else that there's out there. And don't get me wrong, it's not to say that I don't like some of those other asset classes. In fact, I'm invested in some of that stuff, but that would take me years to kind of get up to speed as to how to operate that, how to underwrite that, what's a good deal on triple net. Like, I just don't know any of that stuff. And, I've built a brand around multifamily, and I think this is the time to kind of double down and make it work and get through the next couple of years.
So Ben, one of the questions from the chat, obviously we know the answer to that, but do you guys work with broker dealers to raise capital, or do you or your partners raise all the capital yourself?
No, we don't work with broker dealers. I mean, I'm familiar with the concept. There's a ton of them out there. I mean, we've had a great partnership with Brandon Turner and Open Door Capital too. So I think between us and them, I mean, we do a lot of stuff like this. It's I'm kind of an old school guy. At the beginning of the presentation, I told you I was in corporate sales for 15 years. So networking, going to events, passing out business cards, doing presentations, like that's just my jam. And so for me, it's a very personal sale. And then, you have a good track record and you start getting some referrals on some other stuff. And so we've just kind of done it the old school way, and ultimately we use some new school technology, right? I mean, we were, very astute at, social media and getting ads and stuff like that. So that's kind of helped too. But no, we never gone the broker dealer route. And not to say that I wouldn't, we just never had the need to.
So what are the opportunities for somebody to partner with Disrupt Equity? Other than being a passive limited partner, what other opportunities are there?
I always tell people, if you've got a deal, let's talk. I mean, it's never been just a Ben and Farris show from the get-go. We've always had co-GPs, and obviously they have to add value. But we've had people bring them. One of the deals we closed last year was a deal that a gal that I know here in Houston brought to me. And it was, I kind of kicked myself because we had passed on it originally and didn't follow up with the broker, and she was persistent, and the price kept dropping, and she got it under contract and came back and said, hey, I've got this deal. Do you guys want to partner? And we underwrote it and we said, this is a great opportunity. And so I would say that's probably the biggest value add, is if you have a great opportunity in one of these markets that we invest in, let's talk. I mean, that's how we've grown, is to have co-GPs and people that we partner with.
So that is great. So I don't know if everybody caught that. So if you're looking to become a part of a syndication team, the best way to do that is go find a deal, right? And bring that to the table. And that is the best value that you can bring.
Yeah.
Any other questions?
Yeah, we have a couple more questions. So, and we'll just try to get through the last few so we don't go too over, but this one's a little bit specific to you. So what is your typical number of years for your exit strategy? And you talk long-term, so.
I mean, traditionally it's going to be 3 to 7 years. I think right now it's probably going to be the 5 to 7 year mark, just because, again, I think there's going to be a couple more years of, a little bit of a slowdown that we're going to have to kind of bake into our hold periods. And so, it's not too short and it's not too long. I mean, you start kind of getting to a point where, if you said, hey, I'm going to have your money wrapped up for 10 years, like there's that 10 years seems to be like that mark where like people really start kind of pumping the brakes, because a lot can happen in 10 years. And people are like, do I really want to have $100,000 wrapped up for 10 years with these guys? And so that's probably the biggest challenge that we have in commercial real estate investing, is that it's illiquid. There is some mechanisms to get your money out. I can buy you out, or I can go try to find another LP to buy you out, but that's not always guaranteed. And so, you have to kind of play that sweet spot of having enough time to execute your business plan, sell into an upswing in the market, but also balancing the fact that people don't want their money tied up for decades. So I would say probably 3 to 7 years, but right now, probably 5 to 7.
Awesome. We have 2 more questions and then we'll wrap it up. If you could explain a little bit more on the use of rate cap on a bridge loan, and how much does the lender charge for this product?
So you're buying the rate cap from a third-party provider. SMBC, Goldman sells them. Again, essentially it's a hedge. Think of it as a hedge, right? Okay, so let me try to break it down. So say you bought a deal, and at that point the interest rate in the market was 4%, right? And you bought, your interest rate cap where it's going to start paying at, say, 6, right? So between 4 and 6, you're on the hook, okay? Right? But it hits this, and say it spikes to 10. The cap pays from 6 to 10, right? And the money just goes directly to the operator, and the operator turns around and uses it to offset the mortgage payment that they have to, pay to the lender. And so that's kind of how it works. And over the last couple of years, rate caps went through the freaking roof, because it's all based on risk and where they see the forward curve and where they feel interest rates are going to be. So a rate cap that you probably could have gotten in 2019 for $100,000 was $1 million. But, they start paying out almost immediately. But the bridge lenders almost 99% of the time force you to buy that. It's just, they won't close the deal unless you have one in place. And they do that to protect their investment too, because they don't want you having to stroke a check every month because your interest payments have gone up $200,000. And I've seen that. There's people that I know in the market that didn't buy interest rate caps. They got smoked, and they really were. They were stroking checks for $200,000 every month. And let's be honest, that's just not sustainable. And so they ended up having to sell the deals for a huge loss because they didn't want to, suck out the rest of their life savings trying to support the property. And so that's why, there was one property that we bought a couple of years ago where the lender didn't even expect us to have one. We bought one anyway. And now like the lender's thanking us for place. I was like, you guys should have told me that we needed it in the first place. But we had the foresight that like, hey, interest rates are probably going to continue to go up and they're probably going to be up for a while. We should get a cap. And we did, and I'm glad that we did. So that's kind of how it works.
And one thing to note is the rate caps are not perpetual, right? There is an expiry date on the rate cap.
That's a good point, right? They're typically 2 to 3 year rate caps. Typically after 3 years, the pricing on them just almost goes exponential because it's too far out for them to be able to price risk. So they essentially like, if you wanted to go from a 3 year cap to say a 4 year cap, it's essentially you're doubling your price. And then if you wanted to go from a 4 year to a 5, like you're tripling your price, then they're just throwing crazy numbers at you just to because they don't want to take on that risk. And so, but yeah, and that's another challenge that we're seeing in the market where, people might have, a little bit more left on their loan term, but their interest rate caps are due, right? So say you have a 3 year loan, but you only bought a 2 year cap. Well, now caps have gone through the roof. Maybe you're sucking wind because interest is gone up and insurance is killing you. And now the lender comes back and he says, okay, yeah, your rate cap's up. When are you going to get that new one? You go price it out. It's $1 million. People, they don't have the $1 million. And so what ends up happening is, again, they're fire sailing the property, or they're going back to their lender with hat in hand and saying, please don't make me buy the same strike because I can't afford the $1 million, and they're trying to restructure their loans, which again could be an opportunity because the lender could just say, well, screw you, I'm foreclosing. So yeah, there's definitely a finite amount of time that you can buy the cap.
Hey, George, if you have a question, go ahead quickly. So because we had to move on.
Oh, Ben, thank you. This is George Ndegwe in Dallas. I just got a question.
Hey,
so
buddy.
you say there's some opportunities that you are seeing, especially with those loans coming due and things like that. What kind of asset? I mean, how many your criteria that you're using? Is it number of doors in case something pops up, or is it cap rates you're looking, or value add? What kind of deals are you looking for?
Yeah, our buy box is 150 to 350 units typically. Primary markets. We're trying to. I've gone back on this, but we're trying to buy 1990s and newer. The deal that they're under contract is 1970s. So, it's a loose buy box, but, and then we're looking to solve for minimum at this point, a 17% IRR to our investors. So that's net. So, and that used to be lower, but the market's changed. And so, we're getting better returns for our investors these days because, we're seeing better looks on stuff and pricing is starting to kind of come in. There's one thing I want to mention to everybody. There's a lot of price discovery that's happening. And reason being is sellers are holding out for a higher price because they bought it at the top of the market. There's a lot of buyers that are being greedy and saying, well, I ain't paying that, especially when I have to go pay 10% interest. And there's not a lot of deal volume. So there's not a lot of like activity to justify what the price is. And so what the brokers are doing is they're just throwing out deals and seeing what the market's going to pay for them, right? But that's typically, if it hits that box, and there's typically a story, right? Like right now, I want a story. There's a distress situation with the partnership. It's in jeopardy of being foreclosed on. I need that because my investors want to see that right now. Right now people are like, hey, I'm not stroking a check unless I have at least 17% IRR and there's a story. And so those are the types of deals that I'm typically looking at right now. And I think there's going to be more and more of those in the next 12 to 24 months.